Everyone is telling you to invest, but that first step is daunting. With so much information out there, where would you even start? As a CPA and tax expert, I've talked about tax advantage accounts in Canada, like the RRSP, TFSA, and the FHSA. And something I emphasize is that you have to invest in these accounts to make it worthwhile. Otherwise, your money is just sitting there losing money due to inflation. Plus, why wouldn't you take advantage of tax-free compounding returns in these accounts? In today's video, I will go over the different types of investments you can invest your money into depending on how much risk you can stomach. Before we get started, I just wanted to let you know that this video is not financial advice. Please do your own research before investing your own money and go to your dedicated financial advisor who knows your specific situation. Now that we have that out of the way, let's get right into it. Can you stomach this? You may have heard of scary stories of people losing 10, 20, or even 30% or more of their investments because of the stock market's volatility. Or on the flip side, you may have heard of people making astronomical returns on meme stocks. When it comes to investing, something that you need to understand is that high return is associated with high risk, and conversely, lower returns with lower risk. That is why it's important for you to understand your risk tolerance, meaning how well can you sleep at night knowing your investments might drop X%. Another factor to consider is how soon do you need the money. If you are saving up for a home in the next few years, can your deposit suffer the market swings? Your age also has to do with risk tolerance and the type of investments you might want to make. If you're approaching retirement and need your funds soon, you can't really afford to be as risky with your investments. If you are in your 20s and have a longer time horizon, you can afford to take more risks for potential higher rewards since you have time on your side to ride through those market downturns. You would need to ask yourself these questions before you even think about what sort of investments to make. Before we jump into the type of investments, I just want to share a quick story. I had the biggest scare recently when my YouTube channel was hacked. Fortunately, I was able to act fast and restore my channel before becoming victim to complete identity theft. I haven't taken identity theft that seriously before, thinking it couldn't possibly happen to me, but after that incident, I'm now taking privacy and security very seriously in all aspects of my life, especially something as important as my credit and my financial assets. We know how important your credit score is, which is the first thing that financial institutions check when you apply for a mortgage, a credit card, or if you're looking to buy or lease a car. And with scams on the rise, anyone can become a victim. In fact, the Canadian Anti-Fraud Center estimates that 1 in 5 people will fall victim to identity theft in their lifetime. That is why I want to thank today's sponsor, Equifax Canada. You're likely familiar with Equifax, a leading credit reporting agency in Canada that not only monitors your credit, but also alerts you to potential fraud, helping you safeguard your identity. With Equifax Complete Premier, you get access to Equifax's most comprehensive credit monitoring and identity theft protection, including alerts on new credit inquiries and any changes to your credit score so that you could spot potential fraud faster, up to $1 million in identity theft insurance, web scan to search for your information on thousands of sites where consumers' personal information is suspected of being bought and sold, like your credit card number, email address, bank information, and even your social insurance number, as well as lost wallet assistance and a dedicated identity restoration specialist. If you are a Canadian who wants to be protected against potential fraud, identity theft, and maintain your credit score, sign up for Equifax Complete Premier for yourself or Equifax Complete Premier Friends and Family for yourself and a loved one by using my link in the description box down below. Now let's jump right into the type of investments that you can make in your tax advantage account. Investor number 1, you're risk averse and you have a short-term time horizon. If you are the type of person who can't stomach 20% drop in the value of your investments and swings in the market give you anxiety, then you might be risk averse. Alternatively, if you're planning to buy a home in the next few years and planning to withdraw from your FHSA or RSP or TFSA, then you can also not afford to lose a sizable chunk of your deposit in the case of market downturns. In this case, you need a more guaranteed approach like earning interest income income in a high interest savings account or through a guaranteed investment certificate, also called GICs. The main difference between a high interest savings account and a guaranteed investment certificate is that with a high interest savings account, you have access to your funds at any time, but with that, you tend to earn lower interest rates. With a guaranteed investment certificate, you tend to have access to higher rates compared to a high interest savings account, but there are some restrictions. You have two types of GICs. You have the redeemable and the non-redeemable. With redeemable GICs, you can have access to your funds at any time, but you might not earn any interest income if you withdraw your funds within a certain time period, let's say before 90 days. If you withdraw after 90 days, you may be able to get the prorated interest rate. With non-redeemable GICs, you don't have access to your money within the agreed upon time period of, let's say, 12 months. And if you do end up withdrawing from your non-redeemable GIC before maturity, you will actually be penalized by not earning any interest income for the time your money was in the GIC. The biggest benefit with investing in a high interest savings account or a GIC, a guaranteed investment certificate, is that your principal is protected, meaning that you can't lose your original invested amount. And by investing in a tax advantage account, the interest income that you earn is not subject to tax. And with the current high policy interest rates of 5%, while it's an expensive time to borrow money, on the other hand, you can actually earn higher returns from interest income with lower risk. When it comes to high interest savings accounts and guaranteed investment certificates, you essentially have no risk of losing your principal, and with that, you have a guaranteed but most likely lower returns. Another way to earn interest income is through bonds, which is basically you loaning your money in exchange for interest. After the set term of the bond is over, you will get paid back your original principal. There are different types and quality levels of bonds. There are government bonds, which is the highest quality since it's backed by the federal government. However, since it's considered low risk, your returns will also tend to be lower. There are also corporate bonds, which means that you are lending your money to corporations and your money will help fund that business's operations. With corporate bonds, you will have varying levels of quality and terms. Corporate bonds tend to be riskier than government bonds, but generally safer than stocks. For example, if a corporation goes bankrupt, their obligation would be to pay back their creditors first compared to shareholders. The interest rate that you receive will vary on the credit worthiness of the corporation. If they are blue chip companies, the bonds tend to be higher quality and your interest rate will be lower. There is also something called junk bonds, which are companies that aren't very credit worthy but will pay you higher interest because of the higher risk you are taking with the company defaulting and not getting your money back. Another layer to bonds is that the bond price itself can actually fluctuate. So for example, a bond with a par value of $1,000 might not necessarily be trading for $1,000 during its entire term, but can be traded for below its par value, so let's say $950, or above its par value at $1,050. And the reason being is because interest rates affect the price of bonds. For example, to hit this home, if you bought a bond at $1,000 par value, earning 3% interest, who would buy this bond if you can actually earn 5% in a high interest savings account? That is why the bond will be affected by the interest rates and will actually be traded at a lower value than $1,000 in order to make it competitively priced compared to, let's say, investing your money in a high interest account for 5%. Bond prices work inversely with interest rates. So when interest rates go up, bond prices tend to go down, and when interest rates decline, bond prices tend to go up. Investor number 2, risk taker and long-term time horizon. For those who can stomach bigger swings in the market and are willing to hang in there for potential higher rewards, then you're willing to take some risk. You can invest in individual stocks like Google. Alternatively, you can invest in a basket of stocks called an exchange traded fund, or ETF for short. The difference with investing in individual stocks versus an ETF is diversification. When it comes to a single stock, you're holding more risk because the performance of your portfolio is entirely dependent on how well that one stock does. It might rocket fuel or it might plummet. And to reduce this risk, this is why you would hold a collection of different stocks through an ETF, so that the poor performance of one stock doesn't have the same devastating effect because you have other stocks holding their own. If you are new to investing, investing or you just want the lazy way of investing, ETFs are usually the way to go. Stock picking is a skill in itself, and you are essentially competing with the professionals on Wall Street who do this for a living and do this day in and day out. In fact, it's actually very rare for these professionals to beat the market as well. That is why with ETFs, you may notice there may be a small management fee to manage the collection of these stocks. Be sure to note the management fee percentage of the ETFs, which can impact your overall returns. So ETFs like VOO, which track the S&P 500 index fund, has a management fee of only 0.03%. In comparison, the management fee charged by banks for mutual funds, which are more actively run, can be upwards of 2%, which is quite high and can eat into your returns. Capital gains versus dividends. There are two main types of income that you can receive from stocks and ETFs. The first is capital gains and the second is dividends. You may be familiar with capital gains, which means that if you bought one Apple stock for $62 in March of 2020 and sold it on March of 2024 at $171, then you made a capital gain for $109. Alternatively, you can also experience capital losses. So if you bought Tesla stock during its high in November of 2021 for $407 and sold it in March of 2024 for $175, then your capital losses are $232. You can also earn dividend income from owning a stock or share of a company. So when you buy a stock of a company, this means that you are an owner of the company, but you'll have a very small percentage, like a 0.0001% ownership. Regardless how small your share is of the company, as a shareholder, you might be entitled to profit distributions when companies declare dividends. Note that dividend income is not guaranteed, nor do all companies pay out dividends. For example, lots of tech companies actually prefer to reinvest their profits back into the business to grow its operations. This in turn will grow the value of the company, and you as a shareholder might benefit more from capital gains if you were to sell the stock of the company for a higher price than what you bought it for. However, the blue chip companies that have been around for a while have a proven business that are generating consistent profits. These companies tend to be financial institutions like BMO and TD, as well as energy stocks like Enbridge. Something to consider before investing in dividend paying companies is 1, how long the company has been paying dividends for, and 2, what the dividend yield is. For example, Enbridge has been paying consistent dividends for 69 years and has a current yield of 7.48%. But as you can see, stock price of Enbridge dropped to a low of $35.82 in November of 2020 and highs of $59 in June of 2020. However, your focus might not be the fluctuations of the stock price, as long as the company is paying consistent dividends. If you want to focus on dividend paying stocks for your portfolio, there are actually ETFs that focus on paying dividends that I actually go into more detail in the video linked over here. Even when investing in stocks and ETFs, you can focus on capital gains like those of tech stocks or dividends from blue chip companies, or have a mix of both. Something that you do need to understand is that you are taking more risk when you invest in stocks and ETFs compared to a high interest savings account and or a guaranteed investment certificate, because you can lose part of your principal. However, with higher risk, there are also higher rewards. Especially over a long time horizon, those swings in the market tend to steady out. For example, if you invested in years like 2008 or 2020, you would have had significant losses if you invested for only a few months. However, when looking at the overall trend and looking at a 5 or 10-year period, you would have averaged positive returns. There you have it. I've covered the different types of investments that you can make in your tax advantage accounts like RRSP, TFSA, and FHSA, so that you can be one step closer to your money goals. And if you are a Canadian who wants to be protected against potential fraud, identity theft, and maintain your credit score, sign up for Equifax Complete Premier for yourself or Equifax Complete Premier Friends and Family for yourself and a loved one by using my link in the description box down below. Thanks so much for watching, you guys, and I'll see you in my next video over here.